our world business news, Britain's banks face the biggest shake-up of their industry in decades as they are expected to be forced to separate retail banking from the riskier investment business. The reforms are meant to protect the bank's customers and the taxpayer should the banks fail in the future. Experts say the proposals should help reduce the risk. If the plans are approved, British banks' operations will be split into separate legal entities, so one can fall without affecting the other. However, the changes could be costly, £12 billion according to one estimate. Still, experts believe the ring fencing could serve its purpose and in fact reduce risk.
The Treasury want to avoid is how to deal with another shock like a Northern Rock or the problems that RBS and Halifax Bank of Scotland got into. And if there is a high degree of capital and there is this ring fence around the domestic banking operations, the risk is not completely avoided, but let's just say the risk is significantly reduced of a repeat of UK domestic banking problems.
Meanwhile, British Finance Minister George Osborne said he supports the independent commissions on banking's proposals to ring-fence banks' retail operations and to ensure that private investors bear the cost of failed banks. Greek Prime Minister George Papandreou said he will today reshuffle his cabinet and seek a confidence vote, aiming to push through new austerity measures. Papandreou's announcement came a day after Greek workers voiced their anger about the country's politicians and their plans to further cut back benefits and services.
We are at a historically crucial moment and at a critical time for decisions. And I believe that national consensus is important for the country's interest. Even today, I am communicating with the leaders of other parties towards this direction.
Meanwhile, ECB Governing Council member Welling said the emergency fund for euro area countries should be doubled to €1.5 trillion should private investors be pressured to contribute additional aid for Greece. Those concerns Europe's deficit crisis is worsening drove the cost of insuring Greek debt against default to an all-time high today. To talk about this entire issue further, we're now joined by Bruce Powers, Head of Research at Trust Securities. Welcome to the show, Bruce.
Thank you.
Now, every day we have these horror news out of Greece, especially concerning their debt restructuring. What is your opinion? What needs to be done?
Well, they have few options, and none of them good. One is they continue the way they're going, which is the course they have chosen to take. Second is they default on their debt on purpose, which is not likely to happen in the immediate future. And the third is that they take themselves out of the Eurozone, which is also not a very good option. They're looking for a second bailout right now. In order to do that, they need to implement more extreme austerity measures, including budget cuts and privatizations. The IMF has indicated that in order to go forward, the austerity measures need to be agreed to by both parties so nobody backs out later on down the line. So far, that's where the trouble lies. If Greece does not get a second bailout, they're going to run out of money, which could happen as early as next month, and they're going to default on their debt. And this is what the markets are worried about right now. The longer this takes, the stronger the public opposition becomes, and the weaker their positioning within the European Union becomes, too, for a second bailout. So a lot of uncertainty. I think ultimately you'll see something happen to resolve the situation because the risk to the European Union is very extreme as well.
Let's turn our attention to a story we just talked about, the British banks. Now, the finance minister proposed now is a good time for the state of Great Britain to get out of the banks that they invested in Northern Rock, for instance. Do you think it's now a good time?
Well, look, the government is not in the business of running businesses. And they feel that they've gotten the banks, they've stabilized the system, they've gotten these nationalized banks to the point where a private owner would be able to get better value out of it. Whether they make the right choice as to when they do it, that remains to be seen. And that's pretty difficult to do no matter what kind of environment you're in. But they have said that this probably wouldn't happen until the beginning of the end of this year, maybe the early next year. So there's still a lot that can happen with the economy, good and bad. Who's to say that the economic recovery won't continue to deteriorate from here?
Exactly. That's what they're discussing of late, especially in the U.S. Thanks for coming in. Have a good weekend,
Thank
Bruce.
you.
And now to our other news. Samsonite, the world's biggest luggage maker, dropped 11% in its Hong Kong trading debut today underscoring the tepid investor appetite for initial public offerings as global markets struggle. Samsonite's slump is the latest in a string of weak Asian IPOs. Most of the time, Hong Kong listings attract a lot of interest from retail investors, but Samsonite they didn't find particularly hot today. Its shares traded as low as $166, its IPO price to 20 cents higher at $186 a share, which already was at the lower end of the price range. Despite the share price tumbling, CEO Timothy Parker remained upbeat about the company's sales outlook, especially in China, despite Samsonite suitcases carrying higher price tags than its competitors.
I think there are price pressures in China, but certainly we're not seeing any reduction in the level of growth of our sales at the moment. And of course, everybody in China is traveling more and more, and every time they travel, they need, guess what? Luggage.
Before we go, here's a quick overview of the Asian equity indices as well as the oil and currency markets. And after that, Myrna Nasser is back with the news.